A composite of top global reinsurers appears headed toward meeting their cost of capital in 2025, unless the market experiences an additional $16 billion in net reinsurance losses between now and year end, according to a new AM Best report. We're joined today by the author of that report, Guy Simoes, a senior financial analyst at AM Best. And Guy, your report here is part of AM Best's broader look at the global reinsurance segment ahead of Rendez-Vous des Septembre conference. Can you explain just a bit about the group of reinsurers that are part of the analysis?
Sure, thanks, John. It's a composite of the largest global reinsurance companies, which represents roughly 90% of our top 50, or you can say the whole reinsurance industry. And they include IFRS 17 companies and US and GAAP companies in terms of reporting. And we think that on aggregate, for the purpose of this report, the results are directionally correct. So it's a relevant group of companies.
Overall, how did the return on equity levels fare in 2024, and what were some of the factors in play?
Yes, the return on equity for 2024 was actually 5 points lower than 2023, and it was mostly affected by reserve leverage that reduced in the period. And that was mostly caused by some larger players reporting IFRS 17, which discounts the reserves, such as Swiss Re. There was also an impact from retained earnings, the good performance of this group and the whole industry, quite frankly, in 2024, which increased surplus via retained earnings and also favorable reserve developments. And last but not least, a very favorable market in terms of premium rates, which allows for an increase in premiums without increasing exposure. So meaning that the gross premiums and net premiums grew more than the reserves. So that reduced reserve leverage. So and that was the most impact in the ROEs of these companies, causing the drop. We also had an impact from taxes because in 2023, a deferral tax account asset was created because of the Bermuda tax authority allowed for the creation of this deferral account to kind of cushion the minimum global tax rate that was created in 2023, but in 2024 we didn't have that benefit. So there was a little bit of tax drag as well, impacting the ROEs.
Now, the California wildfires in January have triggered a lot of concern about their strain on overall catastrophe losses. So, Guy, how does the situation look at this point?
Yeah, so far, so I calculate in the report, if we have losses from this point on, meaning additional losses of 16 billion, in excess of $16 billion, that could bring the returns on equity to the point that equates the cost of equity. We consider that to be unlikely, like if you assume the same scenario losses in 2024 happening in 2025, because you would need a very large cat event to cause that impact on ROE. If you consider that roughly 20 to 14% of the primary insured losses transfer to the reinsurance market, you would need something between now and on the order of $170+ billion losses affecting the primary market for the 16 billion losses to transfer to the reinsurance market. So it's unlikely. It's possible, but unlikely.
So what might the performance, as detailed in the report, mean for investors?
It means that ROEs are going to still be above cost of equity capital of 9.5%. So comfortably above, like mid-teens, we expect for the year. When you look at the public traded companies, which investors look, some of them might not be attractive in terms of pricing. Might be when you look at the adjusted ROE or earnings yield I describe in the report, it might be a little bit on the expensive side. However, you still have an attractive ILS market with attractive returns that attracts investors as well. And the market seems to be softening. It's not soft yet, but the rates of return are still attractive.
Guy, thank you so much for speaking with us today.
Thanks, John.
That was Guy Simoes, Senior Financial Analyst at AM Best. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.